Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 19th of January, 2023, a beautiful rainy Thursday here at the home office in Baltimore. We got a great interview coming up for you. Hugh Hendry, former hedge fund manager, podcaster, real estate investor, and quite the eclectic gentleman, I will say. I saw him speak in October at our big Stansberry research conference. We got him on live here for the first time on the show. He's going to talk about the Fed. And let's just say Hugh's not a big fan of the Fed. Talks about bonds, a great opportunity there, and really cautious looking forward right now. And then, of course, the one asset class that nobody's recommended yet on this show that he recommends at the end in his island question, the asset class he feels comfortable owning for the next 10 years. All that and more coming up right now on Making Money. One of the most successful entrepreneurs in America over the past 50 years is going public with his fourth and final prediction about a scenario he calls America's Nightmare Winter. You've probably never heard of Bill Bonner, but in addition to owning an interest in businesses all over the globe, he also owns more than 100,000 acres with massive properties in South America, Central America, the US, plus 3 large properties in Europe. Bonner says, we're about to enter a very strange period in America, which could result in the most difficult times we've seen in many, many years. Bonner has made 3 similar predictions in his 50-plus year career, and each one proved to be exactly right, although he was mocked each and every time. That is why I strongly encourage you to read about Bonner's fourth and final prediction, totally free today. It's all spelled out in a free report we've put together about America's Nightmare Winter scenario. Get the facts for yourself. Go to www.americawarning2023.com. Get your free copy of this report. Even if he's only partially right, it will dramatically affect you and your money. So again, go to americawarning2023.com for this free report. Without further ado, here he is, the man I just mentioned, Hugh Hendry. Hugh, thanks so much for joining the show here for the first time. I got to tell you, I'm a beach guy myself, and looking at you, I mean, I just got back from the fun and sun in Hawaii and sitting in very cold Baltimore right now, raining outside, sweaters on. I mean, I am so jealous looking at that. I mean, my God. I mean, I know you got mosquito problems right now, but outside of that, it looks pretty damn good, Hugh. But again, thanks for joining us. So, I know you're a big macro guy, and I saw you speak at our conference in Boston a few months ago for our Stansberry research company. Tell me a little bit about the Fed. I know you have some very passionate views on the Fed. So why don't you tell me what kind of your view of what they've done in 2022 and kind of setting up here in 2023? Do you think they're on the right path?
Heavens, the Federal Reserve. I guess my point is I want to turn it around and ask you a question and ask you, how many really intelligent people are there in your life that you come across? I mean, impeccably intelligent, just in terms of numbers, just off the top of your head.
I have to say it's probably single digits, to be honest with you. And I've traveled the world. I've met a lot of people in all different, levels of education, levels of economic, situations. But I got to say it's probably single digits, honestly.
Yeah. And that's how I would put 2, maybe 2 people. And, and this for others to listen and answer that question. But I would say embrace those special people because they're so rare. And that's really my beef with the Federal Reserve, that the ask, it's a big ask. It's a big ask. And we admire and we put people in authority, judges, advocates, lawyers, hedge fund managers, portfolio managers, stockbrokers, etc., entrepreneurs. And we put them on a station above, and we anticipate that they're really super intelligent. And then you meet these people and you go, yeah, really? Really? And yeah, I get underwhelmed, if you will, by the Federal Reserve, and their form. The form is the form. The form is not super, in the sense that, can you tell me So maybe I'm prejudicial, and hopefully you're not. But tell me the last time the Federal Reserve really got something super smart, super right, and you went, yeah, these guys have got it. Because
No, I got to tell you, I'm not an anti-Fed guy. Just so you know where I'm coming from, real quick. I'm not an anti-Fed guy, Hugh. I try to give them the benefit of the doubt. Do I think they're in a single digit of people if I met them in person? No, I do not think that at all. I think they're continually chasing their tail, trying to catch up. They're kind of looking in the rearview mirror, doing their job half the time. That's my concern with them.
Yeah, well, that's I'm definitely. I hope you have this sense of restraint on my part. It's too easy to be prejudicial. It's too easy, just to take people down. I'm saying it's a big. They're charged with a lot of responsibility, and unfortunately, I just don't see a spectacular record on getting things right. It seems that they fall into a pattern. They fall into a kind of institutional groupthink. They believe they've got something. I have doubts, grave doubts about these models that they use. I've grave doubts about experts. I wish we could disband all experts. I'd rather have loonies than experts. I'd rather drive very fast without an airbag, but with a dagger protruding from the steering wheel. I think actually you would mitigate a lot of accidents. You know what I mean? And that's where we are with the Federal Reserve. So anyway, what I guess I'm laboring to say is big task, poor track record, and over the last year or so, we've seen the greatest tightening in monetary policy in almost 50 years, and therefore that concerns me. And so I think, true to form, they'll run over a cliff, and when it becomes evident, they will be slashing interest rates, and we're going to go all the way back to the floor.
I agree with you. My one concern is, and I saw Jamie Dimon come out this week saying it has to go way above the Fed funds rate. It has to go way above 5%. We had a couple of Fed governors earlier this week say it has to go above 5%. And I guess what bothers me with that is, why do they have to say that, Hugh? Why can't they let the economy and the market dictate what happens? Why don't they watch inflation for a few months and see if it actually comes down before saying we have to go here because our model says this? As you mentioned, the model has not worked. This model is broken, and we're continuing to use the same damn model. It's insanity that they just can't sit there and think for themselves.
Indeed, and if we go into the Treasury bond market, if we look at the shape and the curvature of expectations, and we look at the track record of that during previous tops and bottoms, it's much better, and it's advocating great caution. Now, that's not determined again by 2, 3, 4 very intelligent people. The amazing thing about these Treasury curves is that there's literally thousands of economic agents, and they're not essentially engaged in this kind of binary buy-sell. There's hedging, and there's just a whole vista of choices that have to be made, commercial risks that have to be controlled. And the pricing, therefore, is the distillation of all of that wisdom. And therefore, no surprise, I believe, that it carries greater weight than a collection of individuals meeting every 5, 6, 7 weeks and trying to determine something. So we have a lot of market wisdom which is urging caution, and it is being rejected. I mean, I had to laugh this week. Reading the Financial Times, the front page had the deputy managing director of the IMF, and saying that they changed from, their view was great caution, consternation about the year 2023. And I was like, yeah, by the end of the year, we're going to be partying again. And I watched a movie last year, The Triangle of Sadness, which is, I'd recommend it to people, not for entertainment purposes. It's kind of like a political polemic. But they have a bit of a satire at the beginning on male models. And it begins with where you have to say Balenciaga, and you look very ponderous. And then you say H&M, and it's Balenciaga, H&M, and it continues
Yeah.
to this end. And that's kind of, that is like the releases you get from Jamie Dimon, from the IMF, from the Federal Reserve, Balenciaga, H&M. Okay. And where are we? The Fed's kind of saying, hey, look, the economy is very H&M. We're all having fun and we've got to make it Balenciaga. But we'll see. Forgive me.
No, that's you nailed that. And for people who don't know what Balenciaga is, they're very expensive, somewhat unattractive clothing. Yeah, if you look at it, nothing against people who wear Balenciaga, but it's usually unattractive. Where H&M is more affordable and more. So, do you think that the Fed will overshoot, though? Do you think this year that they're going to continue to raise?
Overshot. They have overshot.
Okay.
They've overshot. I mean, the market's been telling us since mid-year last year, like arrête. And with this notion of going beyond 5. So, yeah, I'm a simple guy. In the 1970s, we know that they took the rates to 20%, but we also know that the 70s. Was the end of a profound deleveraging, global debt deleveraging, which had commenced in the early 1930s with the bankruptcy of the United States financial system. And we went from 3x debt to GDP to 1. Let's say 1 or 1.2, but let's say 1. Yeah. And so if you were my simple mind, the 1x debt to GDP times the Fed funds peak of 20, 1 times 20 is 20. Today, debt to GDP, depending on your persuasion, is 3.5, 3.6 to debt to GDP. Let's call that 4, and the Fed is pretty close to 5. Determined, it would seem to hit 5. 4 times 5, 20. Like to my mind, we're at the equivalent of 20% rates as we were in 1982. The highs in, and we're going to see the effect on the economy. I think we are seeing the effect. I mean, the inflation prints are going to be, we know the inflation prints are going to be very, very low.
Yeah.
And it's the consequences. It's what that brings on. If they've gone too tight for too long. Microsoft. Anyone heard of Microsoft? Microsoft yesterday laying off 10,000 people. Now, take that on board. That is the very last thing a corporation wants to do. Do you know how hard and the expense of trying to get the right people to get them on your team, and then you got to trash that and get rid of it. It's so disruptive. It's the last thing you want to do, and you only do it when you go, yeah, this economy's in the sink. It's going down.
But let me play devil's advocate. You talked about 1982. 82 is the beginning of basically an 18-year bull market in stocks. Obviously we had technology kind of take off late 80s, 90s. You talk about inflation coming down. If I take a look at it that way, and I view Microsoft as, by the time they lay off the 10,000, it's towards the end of the bad times as far as just the stock market. I'm not saying the economy, it's stock market's concerned. So if I take all that in, again, playing devil's advocate here, that kind of leads me to believe that we're closer to a bottom in equities as far as, maybe not the economy, but as far as equities. Do you agree with that?
Nope.
So you think we have much lower to go as far as equities are concerned?
Yeah.
Yeah.
Sorry.
even if rates do come down, even if the Fed does pivot by the end of this year, you think that just won't be enough?
The Fed, may I remind you, brought rates down from 5.25 to 0. Yeah. In a hasty retreat. From like August, September 2007 into early 2009. What did stocks do? Stocks plummeted, right? When these guys slash interest rates with the tail between their legs, like, oh, darn, we got it wrong again, and they're like, cut, right? Eventually, they had to come in with QE in March. I remind you, Citigroup was pre-split, was trading as a penny stock. I mean, they were all gone. They were toast. I mean, this is what happens when the Federal Reserve tighten. I mean, it could be worse. Could be the ECB. I mean, the ECB raised interest rates in the summer of 2008. I mean, oh my God. You're like, again, there are very, very few intelligent people in the world of finance and indeed in the regulation of finance. And that is the biggest unspoken risk that we're all underwriting. For me, this market is it's very, very simple. You don't own equities. I think there's a huge upside in the long bond. You can buy the ETF, the TLT. So you're getting like almost 20 years of duration. If you look at the price there, it's not like it's retraced to like 2018. It's not retraced to like 2014. It's retraced to 2004. I mean, it's a gift. It's gone 180 to 100. Everything is fine. The big problem is inflation. The IMF, Jamie, the Fed, all these guys that never see it. Good luck with that. So that's where I am.
But when you talk about 07, 08, 09, March 09 ended up being one of the greatest buying opportunities in this generation. So do you see at some point, I don't to put a date on it, but like whether it's 18 months or 24 months from now, once all this shit gets past us, that it creates an opportunity in equities because they come to levels that are generationally attractive? Or are you just basically done with equities for the near term?
No, absolutely. Yeah, I mean, the S&P dropped, I don't know the precise metric, but, close on 60% peak to trough. Mm-hmm. Give me a 60% haircut, Yeah, you could say there are tech stocks. Snap, I think, is down almost like 90%. But I mean, there is a big question mark on its business model. The Facebook Meta is down about 70%. But they're individual names, and there's a lot of specific risk. S&P is down what from the high? I don't even think it's down 20%. Is that the greatest buying? Is that the greatest buying opportunity ever? No,
No, I'm not saying now. I'm saying if we have a situation similar to we had in 08, 09, where we do have a haircut of use 2/3 of the value of the market, we said down 60-some odd percent. So then how do you view gold? Well, how do you view gold in this time? If you're staying away from equities, you look at TLT, which is long bonds. How do you view gold here?
So gold was very kind for me at the beginning of my hedge fund career, and I managed to nail a 50% calendar year gain in 2003 when gold eventually took off, and I found myself again in conflict with central banks in the United Kingdom. They were selling all of their gold, and I was buying it. Gold looks chart-wise, gold looks good, and the relative chart of gold to the S&P looks amazing, and gold in all the other currencies bar the dollar looks amazing in terms of new highs. And even in the dollar, I think we're 12% off an all-time high. Why? Why? Because it is a damn silly asset. And it typically does well when real treasury yields are negative. And they're, depending where, if you measure real yields taking the last, CPI, but we don't do that. If you look at the average and the 5-year forward inflation break-evens, rates have turned positive, and that's what's slowing the economy. So I think the performance of gold is telling you, I think it's very similar to my belief that the TLT is going to tumble. I think it's predicting that the positive real yields engineered by the Federal Reserve will prove very, to use that word, transitory, and we'll have to to pull ourselves out of the train wreck. We'll need deeply negative real yields again, and that will be supportive to gold. I think that's my presumption. What gold's telling you.
Okay, yeah, I mean, you got to look at the chart, and you can't argue. The chart does look good. I mean, it really does. And again, I'm not a gold fan. I don't believe in it long term personally, but the chart right now, it could run, especially if the U.S. dollar continues to fall short term. You can see a little bit of inverse reaction to that, or movement to that. What about just to go to equities real quick? I know obviously not U.S. equities. Do you see any opportunity overseas, emerging markets, anything happening, especially if the U.S. dollar comes down?
I think the U.S. dollar has gone down. I think its next step is going back up. Okay. I've always believed that making money is hard. Financial markets don't like. I mean, I know salespeople say, "Hey, sign here, and we're going to make you this money. We're going to buy this stock." Da da da. But like in reality, markets are curmudgeonly, and they don't like you, and they don't. If you're making money, then someone's not making money. Um, and and for me, again, one of the salient points really is it's not about A to B. It's not like recognizing B, the place you want to be. It's about how you get to B, and the market being very méchant, being very kind of grumpy, and being desperate to prevent you from getting to B creates all this commotion and all of this drama, and which is a longhand way of saying that I think the dollar goes a lot higher because the Fed's made this mistake. And if it's going to go a lot higher, then paradoxically, it has to be kind of volatile. So you treasuries and like the dollar index, the dollar versus the euro, these are not, especially the currency pairs, they're like vols of 6 or 7, which is to say, if you were trying to make a big gain from it, you're going to be like 2 times like the delta value of your position in the currency would be perhaps 2 or 3 times the value of your equity stake. And so in movement, I think we've come down from near enough 110 to 100. That's really hard to hold. And so paradoxically, my faith that we go higher is being demonstrated by this vicious pullback, which turns people from, it's the Bible. Jesus is about to be arrested by the Roman guard, and he's saying to Peter and Paul, it's over, guys. Like the next 12 hours, you're going to reject ever knowing me. And they're like, but you're God. You are the Almighty. Don't be silly. And he's like, slapping them like, but why are you slapping us? And like, because you will reject me. And we know that the cock crows. So for me, the dollar at 100 on the DXY is cock-a-doodle-doo. And there's a lot of people saying, oh, the dollar's done. Well, I don't think it's done. I think it goes higher.
Well, that's not good for gold in my opinion. But I know you got a busy day and we got to wrap here. But I always ask my guests one question, the old island question. But you're on an island, so it kind of screws up the whole question. But if I put you on a deserted island, you, your friends, your family, whoever the hell you want to take with you, 10 years, you can buy one asset, you can buy one stock, one anything, cash, I don't care what it is. What's the one investment you feel really comfortable with for next 10 years you don't have to look at?
Talking my book, I mean, St. Bart's real estate. I think it's probably going to be the same price, but it's unique. It has that crypto thing, the reverse engineering, where they don't want any more exploitation of a very tiny island. And so the permitting just gets harder. So like they're kind of withdrawing the supply. There's really no leverage. You can't get an equity mortgage, an equity loan, and use the collateral of St. Bart's land. And I get to live in it. So yeah. Easy.
You're already on the island. I mean, I don't have to pay for you to go anywhere. Shit, this is great. You help save me some money. But thanks so much. But yeah, thanks so much. It was good to meet you in the conference in October. I'm sure we'll see you again next year. But we'll hopefully get you back on soon. And again, enjoy paradise, man. Enjoy it.
Thank you very much.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.